Hello everybody and welcome to Green Star Trading with me Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right, it's time for an update on the S&P 500 using our proxy, the SPY. We're also going to look at the PCC and the VIX. Got quite a lot of things I want to cover today. We've got bullish cases and bearish cases and alternate cases to look at. Plus I want to go into some classical analysis as well. So without further ado, let's begin. Okay, so here we are on the weekly time frame looking at the SPY, and the first thing we're going to do is we're going to turn off the count, or one of the counts which we were looking at here, and we're going to focus on the classical analysis first. Now, I was only on a live stream yesterday with my patrons looking at the SPY, and I mentioned then that we'd have to see how this week closed, and it's been an interesting close, and it has already made me adjust my opinion about what I said just yesterday. Now, I always present bullish and bearish cases. I may talk about the probability of each, but on that note, the first thing I would want to point out here is the strength of this move. Okay, so we've had a bullish engulfing candle. So all of the prior week from the open of this week was gobbled up by this candle, and all of the week prior to that one was gobbled up by the close of this candle. So this is a bullish engulfing candle, and it has a strong push from volume. Now, one of the things about this move down and this sudden bounce is it's a little deceptive, or it could be seen as a little deceptive, because this is indeed a very bullish reaction. However, the ramping up of volume, okay, drawing these declines, for example, volume increasing with the bearish decline, here volume increasing with the bearish decline. So these moves down have had push from volume on a weekly and on daily time frames. They've been quite strong. Now, we've had these bullish candles before on weekly time frames after these sell-offs, but if I can just highlight a couple here, for example, let's come back in time and let's take a look at another bullish engulfing candle. So here's one here. And let's have it take a look at another one. Here's another one. Right, so all of the price data that was occurred prior to the open of that bullish week was gobbled up by the candle of this bullish week, plus the week prior to that, plus the body of the candle of the week prior to that. The same's true here of these three candles and this bullish candle. But what we can see, if we just use our drawing tool, is on this bullish candle, if we follow the line down to here, we can see that this candle did not have greater volume behind it than the prior week's decline. Okay, and if we look at this bullish engulfing candle, we can see the same here, that this bullish candle did not have greater support from volume or greater push from volume than the prior bearish decline did either. Now, this is where this one stands out a bit, because we can see here that this bullish engulfing candle certainly does have push from volume. So it is without a doubt a strong weekly move. Now, this is where we have to be, I don't want to use the word suspicious, but a little thoughtful about what this could mean, because for the meantime, and this is without a doubt correct, we are still in a downward trend, a temporary downward trend. We are in a longer term upward trend. You know, we've had a high, a low, higher high, higher low, higher high, and for all we know at the moment, a higher low hasn't been confirmed as a low yet. We have yet to set a higher high, but we are still in an upward trend. In the short term, we've been in a downward trend of a low, lower high, lower low, lower high, lower low. And we haven't managed to reverse that even with the intraday weekly pricing of this candle. We are still below the prior intra-weekly price of the high. So we are still in that downward trend. Now, the next thing I wish to look at regarding this bounce is, why have we bounced as strongly as we bounced? You know, there's always a reason. Obviously, if you're looking for a fundamental reason, you're looking to the technical, you're looking to the economic indicators, announcements from the Fed, you're looking to the media cycle, whatever. There's always a reason on the chart as to why things move. So let's just find what I believe to be the most obvious. So let's bring up a couple of fibs. Here we've got one for time and we've got one for retracement. So the first thing we're going to do is we're just going to hide this time one. We don't need that right now. So where did we come to? Where did we come to? We came straight into the golden zone. Now we can see here from our visible range volume here on the right hand side, our volume profile, that we've got a pretty significant peak in the volume profile here. And we can see how if we look at long-term support and resistance, okay, we came straight back into what was prior resistance, now support, and we came through that prior resistance here, which was also support. So we came in back in between two major support levels, some very heavy trading going on here, and we came straight to the golden zone and we bounced like buggery. So that's why we did it, right? If you're ever looking for support, you look for confluence of factors, and that basically means multiple reasons for it to be there. So the volume profile here, obvious horizontal resistance becoming prior resistance becoming support, and the ultimate and the most important fib level there is out of all of them, which is the golden ratio 61.8%, and we bodied a candle on the open exactly there. Sorry, the close of the prior week, excuse me, exactly on the 61.8. So that's our reason for a bounce, and off we go with a good strong push from volume. So overall, on a weekly close, on a weekly basis, looks like a strong candle, and it definitely is, but it failed to break that downward trend yet. Right, so that's essentially the first couple of points I want to make. Let's have a look at the weekly time frame, which gives us a longer term view here. So we're back below the zero bound on the weekly time frame, with the average line having crossed through the signal. The bearish momentum peaked in the prior week and has slacked off this week with a slight upward tick here of the line and the paler bar on the histogram. Excuse me, that's extremely loud. I should have turned my phone off before recording. Alright, at least muted it. Let's just do that now, shall we? I don't know. Too popular for my own good. Anyway, so there we go. We've shown a decline on the weekly basis here of the bearish momentum from the prior week. So it's not a crossover yet. It's not back into bullish territory above the zero bound yet, but it's the beginnings of what could be the case. Long-term downward trend on the OBV here, coming back up to resistance, and we have made a low, lower high, lower low, lower high, lower low here, confirming that downward trend. We've yet to see any weekly bullish accumulation of volume that has reversed this trend yet, but we will be keeping an eye on that in the local sense over this little area here going forward, because any bullish move which is going to take us off to new highs is going to have to elicit or display bullish accumulation of volume over that same period. Otherwise we would end up with divergence between the new price action to new highs and the volume profile. We want to see one thing confirming the other. Now if we look at the RSI, we can see how that prior trend from the May 22 low here, we had strong bullish divergence going into the lows of October on the weekly time frame. Very strong bullish divergence here between these two lows on the RSI and lower lows on the weekly close on price. This led to this rally and overbought conditions, and then we've had this sell-off back to resistance, or support I should say, back up to the signal, and then down here towards weekly oversold conditions, not quite reaching oversold conditions on the weekly, but getting pretty close, and then a very strong bounce back into neutral territory here. So let's move down to the daily time frame now. We're going to do, and we're just going to bring up our moving averages here, and we're just going to close this down for a moment. Right, so there's that 61.8 and 65%, that golden zone there, and there's this strong bounce. Now on the MACD, on the daily time frame, we can see how we've had a little bit of bullish divergence for the average and signal lines here on the closes, where we've had slightly higher lows. So we had some bullish divergence going into that low. We also had a slight decline in the bearish momentum between those lows as well. and then we've bounced. So there was some bullish divergence there in momentum. We can see how the overall, we've only got a day, 2 days of it, but we can see how the histogram is displaying very strong bright green bars. And if we just draw a line from the prior 2 moves that we've had that are bullish, we can see that we've had a slight increase in bullish momentum. We're still below the zero bound though, but if we were to press on for another week of bullish price action, or a couple of weeks, we would start to see this climb above that zero bound, probably dragging the average and signal lines out of this slight downward trend and back into positive territory, which would overall be quite supportive of the bullish move higher, but it hasn't happened yet. The OBV having presented a break of that daily trend from the lows on the on-balance volume in March 23. That's when we actually got lower on the on-balance volume. We've since trended higher, tested that trend, moved up, broken down, moved to a low. So once again, we've got quite a lot of negative bearish volume accumulation here, where we want to see that reversed if we're going to be bullish, and we've got quite a ways to go yet. So it's early days, even though we've had a very strong start. It's early days, and the thing about strong starts in these circumstances is they could be a bear market rally. Like, obviously, you could have a sudden violent move up which grabs after doing a liquidity grab, which gets a lot of people on board. Now, I say bear market rally, that's unfair, obviously, because we're talking about arbitrary terms here. 20% down is a bear market according to CNBC and the talking heads on it, and this move down to roughly 11%, what we would clarify as a correction. Okay, and we've bounced up very quickly and very violently, as I pointed out here. We made a 6.76% move in roughly a week. It's no small feat for the SPY. So now looking at exponential moving averages here, we've had the 10 and the 20 move down, cross through the 60 exponential moving average, all 3 of them trending down, crossing the 10 and the 20 through the 250 daily exponential moving average, which is flattened out, and then we've had this sudden bounce. Price has moved back through the 250, through the 10, through the 20, through the 250, and through the 60 exponential moving average. And the 10 and the 20 are now pointing up, the 60 just starting to turn up, and the 250 just starting to show the slightest beginning of turning up as well. So we've basically come back to the 250 exponential moving average and bounced right off of the 61.8% fib retracement. Now, it's not the strictest of rules, but if we're going to have a bearish phase and find a new low, it's depending on the wave degree we're at, we're likely to come down through. The bigger the correction, the further we're going to move below those daily moving averages on the longer time frame, and on the weekly time frame on even larger wave degrees, we're going to come down even deeper. So we can assume that this correction we had, or bear market, we could say from January 22 down to the low of October 22, we moved significantly below the 60 and the 250 exponential daily moving averages. On the weekly time frame, it was simply a move back to the 250. We're now on the weekly time frame, so there's the 250 exponential weekly moving average, and we moved down to that. We found support at prior support levels. It was also a 50% retracement, okay, and then we moved higher. This time around on the weekly, we've moved through the 60 exponential moving average, and then we've bounced and moved higher. The same. So what I'm kind of hinting at is, if this correction is obviously smaller than this, so this is a smaller wave degree correction of whatever than this was. Now, it could be part of the same structure. So if we were looking at a very bearish count, we would be looking at something like this. But essentially, if this was a completed correction of a larger wave degree, then this move up and back is a bullish move of a smaller wave degree, which will take us to new highs. We'll talk about that in the count in a little while. Let's just pop back down to the daily time frame for a moment, and we're just going to point out a couple of other things that I think are of interest. So let's switch off that for a moment. Okay, now those are the bullish engulfing candles I pointed out. We don't need those anymore. So let's not get too eager too quickly, because in our haste to make ground and to push for new and to push the price higher, we've left some pretty gnarly gaps behind us. Now these more often than not will get filled, so we can expect sooner or later we may push higher next week, we may push out and take out that high first, but essentially this is eventually going to slow down and retrace. So whether we do it from Monday onwards and we come back in to fill these gaps and we look for a 50 to 61.8% retracement here, looking at the waves moving up, or we could push even higher or higher or higher still, but eventually we're going to get a pullback, and it's likely going to come back and repair some of the damage on this chart. So there will be an opportunity for those Elliott wave traders and those on the Patreon who use the STS setup to look for that entry to the long side once we've got a confirmation of a break of a downward trend. That would be a very positive thing to look for. So we've got a couple of gaps that need filling. Now let's just zoom in now and have a look at the daily resistance. Okay, local resistance levels. So we've got resistance at 436.98. These are never precise levels. All I'm doing is looking across through the fixed range volume profile and the visible range volume profile to help line things up, and then I'm just looking for horizontal resistance, okay, and also prior support, which became resistance, as we have support here, as we had resistance here. So we've got a level going forward here roughly in the neighborhood of 436.98. so we want to see price break this sequence of downward moves. Well, I don't know if you want to, or I'm saying we're talking about if we want to confirm things. So we want to break this downward trend of lower lows and lower highs, and the first step to doing that is taking out this pivot here, where we're just going to put in a minor pivot, and it's roughly in the same neighborhood, so we'll just leave a label there, and that comes in at 438.14. so a close above that breaks that sequence of lower lows and lower highs, breaks that downward trend. It will not break the downward trend line based off of the two highs using a base channel, and then after that we've got resistance again roughly in the region of 444.25, okay, where we've got prior resistance here, prior support, prior resistance, prior support, prior resistance. So this is likely going to be a pretty tough area as well. As you can see, since we moved down from the high, the point of control is just above that level in amongst all of the trading up here. That's where the thickest overall level of volume is. Of course, moving in to those areas above those highs, we will have several stops in place, you know, from a trading perspective. So there will be supply, just as there is around this high. There will be supply around these highs as well. Okay. And sell side liquidity up there. So we've got work to do, in other words, to push back through this. I wouldn't expect it to go in a straight line. We're likely going to pull back for a bit first, because, you know, people always get over eager and start buying the highs, so it's only right that we come back and spank them on the bottom a bit for doing it, and then we can move higher after that. Okay, so next thing, take off the local support and resistance. Let's pop that into that local resistance folder as well. Lock that in place, turn that off, get rid of the fibs. The next fib I wanted to talk about was the time zone. Now, I don't tend to use fib time zones all that much, but from the pivot here, which I'm assuming was the beginning of another wave degree, we'll talk about that in a moment, this peak in the volume here and this low, was Monday the 13th of March 23. So from there to the recent high on the 27th of July, we then project in fib time forward. So 0.618 of that length, our little golden ratio here, and between that and equal length, which is represented by the 1618 and the 2 here, is where we found the low on the 61.8%. So you could argue we're in the likely zone to bottom in time frame at the likely level to bottom. So a little bit more confluence again. So I feel like we've done enough now to discuss all of the classical analysis I wanted to discuss. So let's now have a look at the Elliott wave counts. We're just going to go through the bullish case and the bearish case as I see it, in terms of the most what I believe to be the most probable counts. But before we do that, I want to address the old count that I presented a while ago, because this has unfortunately left us in a situation where I'm a little undecided as to what to do with this. Now, The way I was looking at this was that we had a wave 1 into a wave 2 into a wave 3 into a wave 4, and then looking for a fifth and final wave higher. Now it still looks structurally sound if it wasn't for the fact that it's invalidated itself. Price on an intraday basis wicked below the level at 410.00, 410, and that is wave 1 territory. As per the wave rules, this cannot be allowed within an impulse wave, and therefore this is incorrect. However, as was pointed out to me in the live stream yesterday on both the SPX and on the ES1, which seems to be causing a bit of confusion when looking at the futures, because everyone sees the wick here on the futures and assumes that's the wave 1. That is not the peak of the wave 1, it is one high to the left of that, and that's actually seen as the first three wave move of a flat pattern, 3, 3 and then 5 down to here. So what we've got is a situation where if we look to that high to the left of it on the SPX and also on the ES1 futures, this level here at the fourth wave pullback did not invalidate it, but it did here on the SPY. Now the SPY is an ETF of the SPX. It is not the SPX itself, it is not the S&P 500 itself. So all I've said here is old bullish count valid on ES1 and SPX. Now why have I classified it as old bullish count? I have to respect the chart I'm working on and that invalidated. I also have to live with the fact that the wave 4 retraced more than 60, just around 61.8% of the wave 3. This is extremely, well not extremely, but pretty rare for wave 4 behaviour. The next thing I would point out is that the overall move to the high of the wave 3 did not reach the typical target of the 1.618 extension for a wave 3. So we've got a sharp correction, which is that's what it is. It's a zigzag of sorts, and it comes back to the 61.8%. It doesn't seem to belong in the wave 4 position, and it seems to be too deep and too severe to want to belong there either. So I haven't deleted the count, but I think we should push its probability right down to the bottom of the list. Okay, but it's not dead everywhere. So I think holding on to it as the primary or even an alternate to a primary would be the incorrect thing to do here, but I'm not going to dismiss it unless we actually breach that low again, at which point I can delete it. So I just wanted to touch on that in case people brought it up. The next thing, let's start with the bullish count then. So I'm just going to remove this pitchfork for the moment. I may bring it back in if I feel I need to talk about it. So what do we like about this? Well, an explanation for why this wave was shorter, as a expected wave 3 would likely be at the same wave degree, is that it wasn't a wave 3. It was another wave 1 of a smaller degree. So this is what we call a bullish extension. And the idea is that we've had a wave 1 into 2 at intermediate degree, and then a wave 1 and a wave 2 at minor degree, 1 degree less, and now we are moving into a wave 3. The sudden increase in volume and momentum, for the meantime, supports that idea. Okay, the bullish turnaround, so to speak. The other thing which speaks in its favour is the style of correction that's been witnessed. Okay, it's a sharp. It's not a sharp with a P. That needs to be resaved. Let's just add that. I've watched too many episodes of my favourite period drama from the 80s and 90s. Sharp. So everything's sharpy to me. But anyway, there you go. It's a sharp pattern. There's no new price extreme featured within it. It's a double zigzag. W, X, and then A, B, C along the Y wave. It retraces to the very typical target of a 61.8% retracement, the golden zone, which we would expect, which is the most common retracement for a wave 2. It takes the form of a sharp pattern, comes to target, and the move into the subsequent wave 1 and 2 of the wave 3 of 3 at minor and intermediate degree elicits some extreme momentum and push from volume behind it. A good start to a wave 3. They're the points in favour of it. Okay, so what points have we got against it? Let's just pop that into the bullish count and bring it back up. So a couple of channels I want to discuss here. We're just going to turn off once again that pitchfork, because it's basically the reason I'm not particularly interested in this at the moment is because it's a modified shift pitchfork based off of the 1-2 pivot. So in other words, it's a base channel. That's exactly how it functions. It's just obviously gives you some levels within it to work with. Now let's switch off that. So here's a couple of interesting points, right? It's not always the case, but it's likely, and that's about all I can give you, that a subsequent smaller wave degree inside a larger wave degree, which is overlapping 1-2, 1-2, is likely to remain within the base channel set by that prior wave. So that 1 into 2 sets this base channel here, and as you can see, we never left that base channel. Right, this was another argument against that original old account of this being a free. It's unusual for the free to be contained within a base channel, because that means it's not a base channel, it's a corrective channel. At that point, a break out in the free and subsequent backtest is much more likely behavior for an impulse wave, and that's why one of the reasons the wave free reaches out to those higher extensions of 1.618, 2.618, 3.618. It elicits the greatest strength. That wasn't the case here. So the point against this argument a little bit is that we breached this channel. It's not impossible by any stretch, but it is irregular. Normally this prior channel would hold. My logic for supporting or finding support for this count is that we had a sideways correction with a new price extreme in the intermediate wave 2, a very rare running flat pattern. What this does is change the angle of the base channel and make the angle of attack significantly higher, and therefore the subsequent wave has breached it. Now that's a little bit of loosey-goosey rationalization. I don't necessarily believe it myself, but it's just an explanation as to why we ended up with this structure. So there's your first bullish count. So what does this mean, guys? It means that we've just entered the wave 3 of minor degree, intermediate and primary degree. So we are off to the moon, if this is correct. Right, but we are not going to go in a straight line. We are going to have another wave 1 of a smaller degree again, minute degree. Eventually, it could come higher, it could turn around now. And then it's going to come back, find support, and then that's going to be the better entry point for standard trade setup, SES setup that I teach. That we have that 1 up, 2 back, we get a smaller wave degree low in place for our stop, and the margin of error between that and our entry is the risk we're taking on that trade. Right? So that's what we're looking for if we're being bullish. So there's the bullish count. So let's now discuss the bearish count. Okay, so let's turn off that bullish count now, and let's bring up the bear count. Okay, so I gave this primary yesterday, and I feel the principle of doing so is still correct, but my gut and my response to the push from volume of the weekly close has talked me out of it, so I'm just referring it to a bear count. So why is the principle of calling it the primary count still correct? Well, we broke our prior bullish primary, okay, which was that invalidation point that we came through. So that should be discarded in favour of the bearish count, which contradicts it and confirms its breakdown. Right, that's what I did. Fair enough. Also, we are still in a sequence of low, lower high, lower low, lower high, lower low. So the bearish trend is still in effect. As we can see from that channel. No, it's not that channel. I need to add one to here. Base channel. Right. There's the base channel off of the high. It got breached on 2 occasions. And this makes it appear as though it is not an ABC. It is indeed a 1-2, 1-2, 1-2, because each subsequent wave degree smaller is breaching that base channel, and that is typical of how a wave 3 breaks it. So for example, let's just switch off the count so I can make this point. Typically a corrective channel will go from to the low back to the top, right, and that's how we place our base channel. Between those 2 highs, and then the next move will be back to the edge of the channel, and that will be a 3 wave correction complete before moving higher, breaking out, coming back to grab liquidity, and then moving higher again. Right. If we're going to break that corrective channel and transform into a base channel for future support, then we are likely going to break out of it, okay, back test it, and then move lower. And this is typical of going 1 2 1 2 1 2 into a wave 3, which breaches and falls out of that corrective channel. Wanting to keep us on our toes, the current price action is doing everything it can to leave us in limbo land between these two outcomes, where we have a series of lower lows and lower highs, so it's a downtrend, but such a strong bounce and rally that it is close to reversing all of that. And that's one of the problems we've got at the moment. But let's just come back to the bear count and explain how it looks. So the idea is that the move down from January 22 into the low of October 22 was simply the first move of a free wave move lower, a larger free wave move lower. And that would be a W to here, because I still see this as a series of zigzags, because it is not a legal expanding diagonal. Doesn't matter who draws it, it's not. And I'm just not going to tolerate, accept the pattern which doesn't follow the rules. And then we've had a retracement into an X, okay, which is a simple ABC with an extended C, but it doesn't come to the 1618, it just channels perfectly. See what I'm saying? Bum, bum, bum. There's your example of a perfect corrective channel. 1 2, move down to a lower high, 1 2, move down to a lower high, 1 2, down to a lower high, back testing support, and then a collapse. That is still possible, right? But it's not very typical for a wave 2 to retrace as much as this has. It can retrace 99.99% of the prior wave, right? Just can't retrace all of it. Now in this case, this subsequent wave of the minuet wave 2 has retraced all the way up to 90% and bodied just below it, wicked through it, but bodied just below it on the daily close. So this count's still alive. However, if we move through the level at 438.14, then it isn't alive anymore. Okay, because this wave 2 cannot come back beyond the start of wave 1. Okay, so this minuet wave would be invalid. The only explanation I would have then is that this was still 5 waves down, okay, at minute degree, but we are dealing with a flat structure as a correction. So in other words, we are going to go up into an A here rather than a 2, down into an expansive B, and up into a C, right? And then we're looking for retracements from the prior pivot here down to that low, down to this low here, and that gives us a potential 61.8% area where we would have an expansive C and an expansive B. So essentially what I'm saying is that if this level at 438.14 breaks, the current idea of this being 1 2 down again is wrong, and then this count would go from 1 being here and moving the 2 at minute degree over to here, and this would give us that expansive A, B, C flat pattern, okay, and it would be an expanded flat. However, the invalidation for that is at 452.83. If we go above that, I can't in all good faith suggest that that's what's going on, mainly for 2 reasons. One is we've invalidated the wave 1 position in terms of coming back further, but I do consider it unlikely. Why? Because this, even for a sideways correction, is a little too big, much too big you could argue, relative to its parent, which is the minor wave 2 here. This should be smaller, but it isn't. So what could be another explanation for this move down that fits into the bearish count? Alright, well let's look at that. So I know this is getting a little long-winded, guys. I'm sorry, but I want to be thorough. So here's a little bit of a wild card for you. An expanding leading diagonal. An expanding leading diagonal would allow us to come deeper in the 4. It would allow us to transgress this level here, right? The wave 1, because you're allowed to do this in a leading diagonal. We can still break this down potentially into 5 and 5 and 5, although this would be a zigzag now, one would expect. So one would be expecting something like this to get the 4. It doesn't have to be there, it could be even bigger. Okay, as long as it can't come back beyond where the wave 2 completed. But the idea is simple. We have a wave 1, we have a wave 2. The wave 3 is bigger than the wave 1. The wave 4 is deeper than the wave 2 and transgresses into wave 1 territory because it's a diagonal, not an impulse, and the wave 5 is longer than the 3. The problem with these patterns is you can't confirm what it is until it's done. So it's one of those ones where I'm just not a big fan of them because they don't really help you. But it's just there as a wild card in case we do stop below that wave 2 completion here. Then we've got an explanation as to how we could come lower, but I would consider it lower probability. So they're the counts. I know it's taken a long time, so let's just do a quick recap. The old bullish count is technically invalid on this chart and therefore should be considered the lowest probability as it's not valid everywhere. The bullish and bearish counts I would consider equally weighted for the moment. Okay, the strong volume, the strong momentum, and the coming off of a sharp pattern which comes straight to the 61.8% retracement to support before bouncing strongly is very, very reminiscent of a wave 2 correction. And the bearish count, since it failed to take out that high, I have to give the downward trend some degree of respect, some degree of precedent since it's still intact, and therefore will equally weight it probability wise to the bullish count. Not much use at the moment, but we've got clear invalidation levels to talk about once they break, and then we can make a decision and assign primary. But we're left in limbo for the end of this week with 2, I would argue, equally viable counts. So there you go, that's a thorough look at the S&P 500. So now we're going to have a quick look at the PCC and the VIX, and then we're going to wrap things up. I don't think there's anything else I want to talk about, so thank you for being so patient. Let's move over to the PCC then. So where are we on the greed and fear chart here, using our 60 and 250 day exponential moving averages to smooth out all this noise. Okay, and that's just a line chart. There's the actual noise. So you can argue how valid this method is. Some people love it, some people hate it, but the way I look at it is I can add as smaller or as large a moving average as I want to represent that volatility when I need it. I could do a 10-day, 20-day, I could even do a 1-day and just go have the actual price data, couldn't I? That's essentially what we'd be looking at. But I want to look at the long-term extremes, the long-term extremes that we suffer here, that we see here in the PCC. And roughly, if we look at the highs here, 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 and here, and here, and here, we can basically see that the 60 exponential moving average, with the exception of this one max result here we've got for the line chart on the moving average, this is what I would refer to as extreme fear and bearishness. Right, and just as with these lows here, 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 this is what I would call extreme complacency / bullishness, setting new lows in the move down in 2020, which was truly a phenomenal period to be observing market behaviour. Since then, we've moved back up towards that extreme fear and bearishness line. We've had that move, that rally in the markets, that strong rally since the lows, and then we've had another thrust back towards fear and bearishness. Now, bottoms in the market tend to be reached, as this little yellow line shows with the extreme reading here. Bottoms in the market tend to be reached when we reach extreme fear and bearishness, and highs in the market are often reached when we reach extreme complacency and bullishness. Not always the case. This can go on for generally this can go on for longer, but it's often the case that extreme readings are close to, if not marking, lows in the market, and we've just come straight back up here. So that's an interesting little point. So we may move higher. If we do, and we have a sudden eruption of fear, then that would likely support the breakdown of a wave 3 in the bearish case, moving lower. If we suddenly reverse from here and start tracking back down, that might well support the bullish case. Now let's come over and have a look at the VIX. Now we've got some big old readings on here. We've got the 85.47 for COVID, and we've got the 96.4 for the GFC, the Great Financial Crisis. But we've got a whole bunch of other levels which are revisited relatively frequently. We've had the fear of a double dip recession during 2010 and 11. We've had some pretty severe readings throughout prior to that even. And we've had some pretty strong readings since August 2015. February 18 during the Powell pivot days, interest rate hikes. So you can see that level 48.31, it's a rough level, but we've come back to here before, and I like to call that the panic line, because if you ever get beyond that, the shit's really hit the fan. Okay, as you can see, current reading is down at 14.91. We are close to historic lows, and we have been trending up in a new trend here that I've placed to show support. Now, if I were to take it from the all-time low and move it up, I can have a support level like that and suggest that we've broken below it. I think having both is probably fair, just to try and get as many to try and justify that this could be a new support level. So looking back historically to try and find where and why. But generally the overall trend from low to low to low has been broken. We've come back in, back tested it, moved up and come back down again quite violently. Right, we've also got this downward sloping resistance line here and this longer term one here. So what am I saying? For the moment, the VIX is looking extremely suppressed and has done for many weeks, months now in fact. And that suppression has been getting more and more severe over time, where we've set lower highs, as we've also set lower lows as well. So generally the VIX is very docile, very suppressed at the moment. If a sudden break higher through this resistance, then these prior highs, and a push up in the PCC supporting the breakdown of the price in the stock market and in the SPY, I think it would be a very strong case to support the bearish argument that we're entering a wave 3 of a larger 3-wave move correction, and we're off to new lows, taking us below the October lows of last year. However, if the VIX continues to trundle down as it has done many times, it won't stay down in a single pattern trundling along forever. There are always little spikes. It's just a fact. It's just the way the market is. There's always little spikes. But for the moment, it's suppressed, and the PCC has come back up to the peak again. So the way I tend to operate normally psychologically is, if these levels approach extremes like we have here, I tend to be a bit contrarian, and therefore feel that that might well be a sustainable low. And as we've seen, we've had the push from volume, bullish engulfing candle, and we've reached extreme levels in the PCC. That might well be a sustainable low, but we can't confirm it yet. So there you go, guys. Thank you very much for joining me on this technical analysis of the US stock markets using the SPY as our proxy for the S&P 500. If you're new to the channel and you like what you've seen, please subscribe, smash the like, hit the little bell notification icon to remain informed of future video releases. And if you're interested in learning how to do Elliott Wave, and you want to get access to the weekly live streams and a whole bunch of educational material, you can consider joining the Patreon. There's a link in the description box below. You'll be very much welcome. And if you're not following me on Twitter, you can find the link to that as well. Alright guys, take care of yourselves, and I'll be back with you as soon as I can. All the best. Bye bye.